If you have $100,000 sitting in a savings account this morning, it is losing about $2,900 a year, and your statement will never once show you a loss. Hold on to that number. We're going to come back to it. Last Tuesday, the 18th of August, two things happened on the same day, and almost nobody put them next to each other. The first one made the news. Total government debt closed above $40 trillion for the first time in history. 40 trillion. That works out to roughly $300,000 for every household in this country. The second thing got covered, and then it got dropped by lunchtime. Nobody put the two of them side by side. The 30-year Treasury bond touched 5.33%. That is the loan the government takes out for 30 years, and that is the highest rate it has paid since 2007. 19 years. I didn't go hunting for that number, by the way. It came to me. It sits on a dashboard I built for myself, next to five others I watch every morning, and I'll tell you how that works later on. So here's where we're going. First, what the government did the very next morning. Then, why the bond market went up last week, and why that's worse news than if it had gone down. Then, what it cost you, in dollars, this year. And then the one asset nobody had to rescue. Let's start with Wednesday. Wednesday morning, the 19th, the Treasury Department put out a press release. No press conference, no briefing, just the release. They announced they are doubling the buybacks on their long-dated bonds, the 10-year through the 30-year. $2 billion per operation becomes at least $4 billion. Those are their words, not mine. By at least double. Their stated reason is a phrase doing a lot of work. They called it liquidity support, meaning we're not setting the price, we're just making sure somebody can always trade these. That's the official story, and I want it on the table before I tell you why I don't think it's the whole one. Now stop and hear what that sentence actually says. The people who sell the bonds announce that they are going to be the people buying the bonds. Let me act that out because this is easier to follow as an argument between two people than as a policy. The government walks into the room and says, I need to borrow money, a lot of it. And the buyers say, fine, what are you paying? And the government says, 4.5%, same as always. And the buyers say, no, you already owe $40 trillion. You add $2 trillion more every year. You freeze other people's money when you're angry at them. Pay me 5. And the government says, that's too much. And the buyers say, then don't borrow. So the government walks out. And Wednesday morning it comes back and says, fine, I'll buy them myself. Here's the part I have to say out loud because somebody in the comments will run these numbers anyway, and they'd be right to. It worked. The 30-year went from 5.28% down to 5.19% in a single session. Biggest one-day move of the month. And when the rate goes down, the price of the bond goes up. So bonds went up last week. And let me hold myself to the same standard I'll hold the other side to later. 0.09 of a point in one session isn't proof of anything either. Other things happened that Wednesday. What I can say is the move came in the session right after the release, in the direction it pointed, at the exact maturity it named. I am not here to tell you the bond market crashed. It did not. If you owned a long-term treasury fund from that Tuesday to yesterday, you made about 2%. That's the good news. Now let me tell you why it's the bad news. There's a diner on a 2-lane road outside of town. Good coffee, fair prices, nobody stops. So the owner asks his brother-in-law for a favor. Park your truck out front, sit in the window seat, nurse a cup of coffee for a couple of hours. And it works. Cars coming around the bend see a truck in the lot and a man in the window, and a few of them slow down and pull in. The owner looks out at his own parking lot and feels better about Tuesday. But here's the thing about the brother-in-law. He is not a customer. He is furniture. He didn't smell the coffee from the road and decide to stop. He was asked. And the morning he needs that truck for something else, the road goes right back to telling the truth. Last Wednesday, the Treasury parked its own truck outside its own diner. Now, how big is that truck? Smaller than you'd think, and I want to be honest about that too. Doubling those buybacks adds about $14 billion over 3 months. Call it a billion a week, against a bond market of about 30 trillion. That's 0.05% of the thing it's supposed to be fixing. Once a week, against something that trades close to $1 trillion a day. Rebecca Patterson at the Council on Foreign Relations, who used to run money at the biggest hedge fund on earth, said it plainly. Buybacks are more signal than substance. And she's right, which is exactly what makes this frightening instead of reassuring. Because a press release worth 0.05% of a market just moved the price of 30-year money in one afternoon. That does not happen in a market that is trading the bond. That happens in a market that is trading the man who issues the bond. And you don't have to take my word for it. The Treasury Secretary went on television the next morning and said it himself. Part of it, he said, is signaling here to show that we believe the yields don't reflect the underlying fundamentals. Read that again. The man who sells the bonds is telling you he thinks the market has priced them wrong. Signaling. That's his word, not mine. Fortune reported the next day that Stanley Druckenmiller's read on it was blunt. This wasn't liquidity management, he said. It was price management. And you can hear the whole argument in about 15 seconds if you let the two sides talk. The secretary says the yield is wrong. 5 1/3 is not what this country's debt should cost. The market's being emotional. And the market says, I'm not being emotional. I'm being paid. And he says, but we're the United States. We've never missed a payment. And the market says, I know. That's not what worries me. What worries me is you paying me back in money worth less than the money I lent you. You've done that before. And he says, I'll buy some back myself to show you I mean it. And the market says, with what? That's the question that doesn't get asked much. The money to buy those bonds back doesn't come from a savings account somewhere. It comes from selling more short-term debt. He's borrowing at the front to buy at the back. He is paying off one card with another card. So what did all of it cost you? Let's do the arithmetic they skip. The average savings account in America pays 0.38%. That is not me picking a bad bank. That is the number the FDIC publishes for the whole country. And yes, I know. Some of you have a high yield account paying 4. Good. You're one of the few people in this country actually breaking even after inflation. But that FDIC number is the whole country. And the whole country is not in your account. That's not an insult. That's the size of the whole. Prices went up 3.4% over the last 12 months. So on $100,000, you earned $380. And you lost about $3,300 of buying power. Net, you are down about $2,900 for the year. Economists call that a negative real return. I'd call it a hole in the bottom of the bucket. And the statement says you made $380. Now hold on, you might be thinking, my money didn't go anywhere. The number in my account went up. Right, it did. That isn't a defense. That's the mechanism. And it is worse in the place people put money precisely because they want to be careful. Take the biggest, plainest, most boring bond fund in America. Millions of retirement accounts hold it. Over the last 5 years, it returned about 0.07% a year. Basically flat. Never a scary headline, not once. Over those same 5 years, prices went up almost 23%. So $100,000 went in, about $100,300 came out. And it buys roughly what $81,600 used to buy. 5 years. 18% of the groceries, gone. And not one monthly statement ever printed a minus sign. And if somebody told you to be extra safe and go long, it's worse. $1,000 you put into the 20-year plus Treasury fund 5 years ago, dividends and all, is about $669 today. The share price by itself, measured from its high in March of 2020, is down more than half. I have seen this trick before, from the other side of the desk. In 2006, I walked into the mortgage business, and the first product they tried to teach me to sell was called Pick-a-Pay. The advertised payment was 1%. The real rate was closer to 10. The difference didn't disappear. They added it to what the borrower already owed. So every month, that man got a statement showing a payment he could afford. And every month, he owed more than he did the month before. I said out loud, in 2006, that it made no sense. I wasn't a prophet. I just refused to unknow the arithmetic. A savings account paying 0.38 while prices run 3.4, is that exact same loan? Pointed the other direction. You're the lender now. And the difference is getting added to what you're owed, except this time, nobody is writing it down for you. Those two numbers, the savings rate and the inflation rate, sit side by side on the free dashboard at timtalksfinance.com/members, so you never have to go hunting for either one. So now let's line them all up. Every single thing in this story that is supposed to be the safe place. The 30-year bond. There is a man who decides how many of those exist. Last week, he decided to make more of them, and then he decided to buy some of them back. The dollar in your savings account. There is a man who decides how many of those exist. Since January of 2020, the money supply is up 50.5%, 7.79 trillion new dollars. Some of that Congress voted on. A lot of it, nobody voted on at all. The short-term government bill, the thing everybody has been rolling into because it feels safe, those are now 22.2% of all the government's tradable debt. The Committee of Wall Street Firms the Treasury asks for advice said the number should sit between 15 and 20%. So they are above the ceiling their own advisors gave them. And that matters for one blunt reason. Short-term debt has to be paid back soon, which means it has to be borrowed again soon, at whatever the rate happens to be that day. It's an adjustable rate mortgage on the entire country. 22 cents of every tradable dollar this government owes has to be refinanced inside of a year. In fairness, that same committee says there should be room to move outside the range in a pinch. Fine. But we're outside it, and we've been outside it a while. Here's what that already costs. From last October through July, the government paid $963 billion in net interest. Over that same stretch, it spent $763 billion on the entire military. Interest beat the Pentagon by $200 billion. Put that on a kitchen table. It's a household where the minimum payment on the credit cards now costs more than the car, the insurance, and every dollar of home repair put together. And its answer, last Wednesday, was to open another card. Even gold. And I want to be fair to gold here because gold has done its job. It's up better than a third over the last year. But gold can't move at the speed of the internet. A coin in your safe is fine. Gold that has to move needs a ledger, and a ledger needs somebody you trust to keep it. Gold is the on-ramp. Gold is not the exit. Every single door they are building for you has a doorman standing in it. And then there's the one that didn't need anybody. In the same week, the Treasury had to park its own truck outside its own diner. Bitcoin went up more than 20%. It went from about $64,600 at that Tuesday's close to $81,265 at the following Tuesday's high. Whatever ranking you want to give that week, here's the only thing about it I care about. Nobody announced it. There was no press release. There was no buyback. There was no secretary on television explaining that he believed the price was wrong. Nobody had to be the buyer of Bitcoin. There was just a buyer. And I'll be precise about what I'm claiming, because people get sloppy here. I'm not saying Bitcoin went up because of the buyback. Nobody can prove that. What I'm saying is narrower. In the same 7 days, one of these two needed an announcement from its issuer to hold its price. The other one didn't. Now, somebody's going to say Bitcoin has trucks out front too. Funds. Companies that announce their buys. Even the government holds some. True. And it doesn't touch the argument, because not one of them can make more of it. A big buyer moves the price. An issuer moves the supply. That's the entire difference, and it's the only difference I'm claiming. Bitcoin has no brother-in-law. There's nobody to call. The road tells the truth about Bitcoin roughly every 10 minutes, and it has been doing that for 17 years. The first time Bitcoin ever walked into my life, it wasn't a podcast or a price chart. It came inside a mortgage file. A client buying a condo in Scottsdale, and a big piece of his down payment was in Bitcoin. The underwriter told me she couldn't use it. Her words, roughly, were that they had to treat it like drug money. I could have argued with her. I didn't. I showed her the ledger instead, and told her Bitcoin is a ledger just like the one her own bank keeps, except this one is public, and anybody on earth can read it. Then I let her go look for herself. A couple of days later, she came back and said the funds were fine. That's the thing about Bitcoin I've never been able to unsee. You don't have to trust anybody's word about it. You can go read it. Try that with the money supply. And it changed how I look at prices, permanently. I started measuring houses in gold and in Bitcoin instead of dollars. And measured that way, houses were getting cheaper. They were only going up when you measured them in dollars. The houses weren't getting more valuable. The dollars were getting weaker. Change the denominator, and it changes the equation. And here's the number that is the whole argument. Bitcoin's supply grows 0.82% a year. Right now, there are about 20 million and change in existence, out of 21 million that will ever exist. 95.6% of all the Bitcoin there will ever be is already here. And in April of 2028, that 0.82 drops to 0.41, cut in half, automatically. Nobody votes on that. There's no meeting. There's no committee. There is no press release on a Wednesday morning that changes it. Let me put the two of them on the same clock, because that's the only fair way to do it. Since January of 2020, the money supply is up 50.5%. Over that exact same stretch, Bitcoin supply is up 10.5%. Same window, same 6.5 years. One of those two numbers was a decision somebody made in a room. The other one was arithmetic that ran on schedule while nobody was allowed to touch it. That's the whole reason I keep landing here, whatever door the news opens with. It isn't that Bitcoin is exciting. Most weeks Bitcoin is not exciting. It's that Bitcoin is the only thing on the menu where the answer to who can make more of this is nobody. That is the entire difference between the two things. And last week, the market showed you which one it believed, in real time, with real money, in the same 7 days. Now let me give you the other side, because I'm not going to hand you a clean story. Bitcoin is nowhere near its own high. It topped about $126,000 last October. As I record this, it's near 78,400, roughly 38% below that. It fell hard and fast to get here, and it can do that again. Anybody telling you Bitcoin only goes up is selling you something. Gold isn't at a record either. It's about 17% below where it was in January. And Bitcoin is volatile in a way that a 68-year-old with $200,000 saved should take seriously, not wave away. A thing that can rise 25% in a week can fall 25% in a week. Bitcoin has done exactly that, more than once, and it will do it again. Anybody handing you the upside without the drawdown isn't being straight with you. And the buyback the Treasury announced hasn't even happened yet. As I record this, on the 27th of August, not $1 of it has been spent. The first operation is September 9th. They moved that market with an announcement about something they have not done. So none of this is a prediction. There are no certainties here. There are only probabilities. But here's the probability I'd ask you to sit with. Everything on Earth that stores value, the houses and bonds and stocks and gold and cash, adds up to somewhere in the high hundreds of trillions, depending on whose count you use. And it's starting to move onto digital rails. That's what tokenizing means. Your house, your bonds, your savings, turned into an entry on a ledger. And every single one of those tokens will still have a man who can make more of them. Except one. 21 million. Fixed. Forever. No servers, only a protocol. You don't need a percentage from me, and you don't need a price. You only need to notice which way the one-way door faces. Every single thing on that list can be made more of. One thing can't. And I'll be careful here, because this is where people on the internet start yelling at you. I'm not telling you to go buy Bitcoin this afternoon. No price target, and don't sell anything you own. What I'm telling you is, there's one short question worth sitting with at your own kitchen table. Which asset has no issuer? That's it. Ask it about the bond. Ask it about the dollar in your savings account, the short-term bill, the tokenized fund, the stablecoin, the money market. Every one of those has a name, an address, and a person who can make more. Ask it about Bitcoin, and you get silence. Nobody's there. That isn't a bug in Bitcoin. That's the entire product. I'm one guy with a perspective and an argument for how I got to it. You are completely free to disagree with all of it. But run the numbers yourself first. That's the only thing I've ever asked anybody to do. Free, no credit card, about 2 minutes. Every live number I use today sits on the Macro Command Center at timtalksfinance.com/members. The 30-year, inflation, the savings rate, gold, and Bitcoin. One screen. Full package members also get the alert when a number crosses a line. I built it because I got tired of opening 9 tabs every morning. Last week, the safest asset in the world needed a phone call. Bitcoin didn't. There was no committee, no press release, no Wednesday morning. Just a ledger doing what it has done roughly every 10 minutes since 2009, while the safest asset in the world waited on a man to pick up the phone. That's the whole video.